Hi, today is Monday the 9th of August and this is the SPX Outlook for the coming week. I just watched my last report a week ago and it feels like I could just post the same all over again. I mean, nothing has really changed. Okay, FOMC is behind us now, earnings season is over. Besides the bullish congestion that we are seeing here, nothing has really changed. So I'm going to make it short. This is a 4-hour chart and we have broken new highs or close to recent highs on the 3rd, on Friday 6th. I mean, probably before market opens we reached 44.40. We're going to look on the 1-hour chart that it is actually close to the stall level. And the market is indeed congesting here, but there's really no bearish pressure whatsoever. We see here the high level bar about 4400, 4410, and we have seen that in the last few weeks the resistance levels was being tested several times for support. And yet again, as you can see, the resistance level is still the same and there's no, the market is still in bullish congestion to grinding up mode, but yet it's not really going much higher at the moment. Okay, so this is for the 4-hour chart. If we look at the longer time frame daily, of course, this is very bullish. And here we see that the resistance has moved way higher. We have to take heed of this, that the market is definitely not ready to retrace, maybe retrace, but not to go into correction soon. So we have to go with the flow. The market is still bullish, no matter how irrational that can be. So we have to take into account that the market bounced off 40 to 30 late July and it's still in grinding up mode. I plotted on the 1-hour chart, which we're going to see here in a minute, that we have fib expansion targets. The one on 44.33 is close to the stall level, but it could go higher. We see 44.85 and 45.36. So unfortunately for market neutral traders, there's no indication the market is going to retrace, but we have quite a few interesting support levels to watch if that happens, because August can be pretty tricky. Sometimes there will be very little news apart from the FOMC minutes in a couple of weeks. And now, unless there's some exogenous factor, being the Delta variant, be it the build-up of the US-China war, I invite you to watch the news. I'm not going to go into geopolitics right now, but yes, there are still ominous clouds building up, so we have to go with the flow, but with a little bit of caution. So now let's go to the 1-hour chart for today. Here we see that the actual resistance is no longer 43.75, but it's actually 44.55, and we see the high volume bars is still around 4400, 4410. The market may try and grind up. We see here the stall level in the dotted line. That was more or less where the market bumped on Friday, and we will see whether it bumps again. 44.53 should be hard to break, at least in the short term. But we've seen that, yes, the market is prepared to go higher. I always take the daily chart with a pinch of salt because it's very slow and there could be sometimes wrong signals. So 1 hour and 4 hours are to be followed for more accuracy. So here we see that the high level bar equates to the pivot level. So the market seems comfortable in the upper half of the range from 44.15 to 44.55, and yes, it can go a little higher, and for that we have to check the high level correlation with NDX. So as long as people buy into tech stocks, especially the Amazon, AFB, and or Google, etc., yes, the market will not go into a correction. I would say for the time being, this is just an extended trading range with new highs, but yet we see that we had former all-time highs on 44.30, so it could bump around here, congest around here. We will see whether the market can really break new highs and maybe go to 44.55. I would say without news really affecting the market, SPX should just keep to this kind of extended trading range. The trading range as such is 43.75, 44.55, which is pretty wide by historical standards, but we have to live with it. Volatility can be the realized volatilities can sometimes exceed the implied volatility. The VIX on Friday, if we look at the correlation, we see, well, not only that the SPX VIX correlation is going back to normal, still below normal, but it's improving, which means that the anomaly what we saw for about 2 weeks is now resolving itself towards going to its long-term average, and yet it didn't happen with a correction. That happens, we have to take cues about that, but nothing really happened. If we look at the VIX term structure, it is in contango, no much risk. Well, again, it's all relative. 18.9 is relatively high for a short-term front leg VIX future. Well, the VIX has gone up a little bit this morning. It's around 17 or so, which is relatively high for all-time highs. But at the same time, it looks again that the risk is being pushed further down the line. So again, cautious bullishness is the way to go, and we will look at that in the next video about current trades. So I would say, if we go back to, I would say again, bullish congestion to congestion. Check these levels, 44.10, 44.15. Check these levels, 43.75, which was tested several times for support. The market could go up, but I would suspect it will congest for a few days. So please follow my updates on Slack. For the time being, this trading range is doing absolutely fine for the ongoing trades. Thank you for watching, and bye for now.